This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Here in Chapter 16, we start our studies of corporation tax. Now, the only reference we've had previously to corporation tax was back in our introduction to the F6 UK subject. And there we referenced that you had a guaranteed Section C constructed response question. One of the two 15-mark questions will be given over to corporation tax. Now, in addition to that, of course, there could be a handful of questions in Section A, the objective testing questions that cover corporate tax. It is a significant tax. It's probably second only there to income tax in terms of our order of importance and significance in terms of the syllabus content and therefore exam content. Now, in terms of corporation tax, first thing that we need to know is its scope. Who is going to pay corporation tax? And the answer to that, as you'll see here in your notes, here on, there we go, page 105 at the beginning of chapter 16, who pays corporation tax? It will be a UK resident company. UK resident companies are liable to UK corporate tax on their worldwide income and gains. Notice their income and gains. Companies, UK resident companies, chargeable to corporate tax, they do not pay capital gains tax. We've seen in recent chapters how individuals are subject to CGT, but not so for companies. Companies pay one tax, it's corporate tax, on all of their profits, a figure that we'll see soon on the pro forma known as taxable total profit. And that taxable total profit is a combination of their worldwide taxable income and taxable gains. There's a slightly different method of calculating the chargeable gain, an extra step that wasn't involved in terms of individuals that we made reference to at the beginning of our studies of CGT, but we'll see that in later chapters within the corporate tax area. So a UK resident company is liable on worldwide income and gains. What makes a company UK resident? Well, one, very obviously, as you'll see here, if the company is incorporated in the UK. So if it's A Limited or A PLC, that is clearly a UK resident company. But what you might have in reality is A Inc. A Inc. incorporated in some overseas country there. Now that you would think would make it non-UK resident and therefore free of any UK corporate tax exposure. But not so, because the second criteria that dictates whether a company is UK resident is based on whether the company is centrally managed and controlled from the UK. Well, what do we mean by central management and control? Who manages and therefore controls the operations of the company? It's directors. So if you were told that you had A Inc. incorporated in Italy, but the majority of the board of directors lived in the UK and they met in the UK for board meetings, that would be clear evidence that central management and control was being exercised from the UK, and therefore still it would be UK resident, and therefore UK corporate tax would be chargeable on all of its worldwide income and gains. Now, if of course any overseas tax, like in Italy, had also been suffered, there is a relief system known as double taxation relief, but none of that is a worry for you at F6. The pleasures of that await you at P6 there, so something to look forward to, no doubt. Assuming therefore we have a UK resident company, we need to prepare for it a UK corporate tax computation. And to be able to understand the basic preparation of those computations, there's a few definitions that we need to become familiar with. Historically, there's been three basic definitions that we need to be familiar with. A company's period of account, and then it sounds very similar, but there is a technical difference. The company's chargeable accounting period, and then a financial year. Now, the first two of those definitions are still important to us because it will dictate then the period for which any corporate tax computation is to be prepared. Clearly, a basic idea, a basic issue that needs to be resolved. You need to know the period for which you are preparing this corporate tax computation and in relation to which period corporation tax will be payable by the company. The third definition, though, there of financial year, we still need to be familiar with it, but the significance of financial years has been in relation to those financial years. HMRC have set the rate as it is now, or previously as was, the rates of corporate tax. Now, when there were different rates of tax, we needed to know what happened in terms of the financial years and the tax rates that would be applicable. What we have at this point is one, a single rate of UK corporate tax. It's set at 20%, and it's the same in recent financial years, at least as far as you're concerned. So although, yes, for a financial year, we'll talk about what dates that and what period it is, we set the rates of tax. For us, in this F6 round of F6 UK taxation exams, it's going to be 20% corporate tax rate across the board. But let's look at that first definition, the definition of the period of account. Well, quite simply, as you'll see, it is just the period for which the company prepares its accounts. So you'll be familiar with financial accounting, financial reporting, and a statement of profit or loss. So the company prepares its statement of profit or loss, and for whatever period it prepares it for, that is the period of account. Now, usually, the period of account would be for 12 months. It sets a regular accounting year-end date. But maybe when it first started, it had a start date and it didn't choose to prepare its accounts to a date 12 months later. Or at some later point, it's changed its accounting date, or maybe when it ceases to trade at the end of its life cycle, it doesn't cease to trade on the very last day of trading. So what happens, therefore, if we have a period of account of either less than or more than 12 months? I say it could happen very easily. A company starts to trade on the 1st of October, let's say 2016, and it decides that it would wish to prepare its accounts to the 31st of December. Well, it's got two choices. Its first set of accounts from the 1st of October 16 could go October, November, December for the 3 months through to the 31st of December of 16. Or as that is only 3 months into this business starting up, it's got better things to do than be preparing now and presenting the accounts. It may prepare a long opening period all the way through to the following 31st of December, say the 31st of December 17, and therefore have a 15-month period of account. So those periods of account, though normally 12 months, may be short, less than 12, may be long, more than 12. It is purely the period for which the company prepares its accounts. The second definition is here the really important one, because this is the definition of what we've stated here to be the company's chargeable accounting period. And the reason why this is the most important one is that we prepare a corporation tax computation for the chargeable accounting period. We prepare the corporate tax comp, we calculate the corporation tax liability, and that corporation tax is payable by reference to that chargeable accounting period. So what is the chargeable accounting period? Well, in most cases, it is pretty obviously very, very simple. It is the same as the company's period of account. The company prepares its accounts to the year ended 31st of December in each year, and we prepare the corporate tax computations for the chargeable accounting periods to the year ended 31st of December. The period account is usually the same as the chargeable accounting period, but there's one rule that we need to learn here, and that is that the chargeable accounting period cannot exceed 12 months. Notice I haven't said it has to be 12 months, but it cannot exceed 12 months. So you could have a short period of account. You could have a short period of account becoming a short chargeable accounting period. So in my example of a moment ago, the company started to trade on the 1st of October 16, and let's say it did then prepare its accounts for the 3 months to the 31st of December 16. That would be a short period of account. 3 months does not exceed 12, and therefore you prepare the corporate tax computation for that same 3-month chargeable accounting period. But if, on the other hand, the company decided to trade through to the 31st of December 17 and then prepare its set of accounts for the 15-month period of account through to the 31st of December 17, you would have a long period of account. Then we have a problem. We cannot and will not prepare a corporation tax computation for a period of more than 12 months. So how do we resolve this problem that the starting point for the preparation of the corporate tax comp, the accounts, they are for a period of 15 months? Very simple. We will, from that long period account, prepare 2 corporate tax computations. The first will always be of 12 months, and the second will be the balance of months up to that period of account end. So with our 15 months to 31st of December 17, we would then prepare 2 corporate tax computations. The first 12 months, that would be 12 months from 1st of October 16, so through to the 30th of September 17. That would be 1 corporate tax computation. We would then have a second corporate tax computation for the remaining balance of period of time, the 3 months to 31st of December 17. So from 1 period of account, 1 statement of profit or loss, we'd have to prepare 2 corporate tax computations. Now, of course, what we've got to see first of all is how do we prepare 1 corporation tax computation from 1 period of account. We'll later deal with how do we prepare 2 corporate tax comps for 2 chargeable accounting periods from what would be a long period of account. It's not difficult, and it's very basic and simple rules that need to be learned, but we'd best deal with 1 corporate tax computation before we start playing around with 2. So the company's period of account, the period for which it prepares its accounts. The chargeable accounting period, usually the same as the period of account, but it cannot exceed 12 months. If the period of account is short or is anything up to 12 months, the period of account becomes the chargeable accounting period. If it is a long period of account, 2 corporate tax computations to be prepared. The first of 12 months, the second is the short one for the balance of months. Right. We then got this financial year issue. Now, financial years run from slightly more sensible dates than the tax year that we dealt with in personal tax there, but run from the 1st of April through to the following 31st of March. And they are denoted by reference to the year in which they start. So financial year 2016 begins on the 1st of April 16, and that would go through to the 31st of March 17. But as we've said, from financial year 2015 onwards, we now have just a single 20% rate of corporation tax that applies to all companies, irrespective of the level of profits. We used to have a situation where there was a rate for small companies and a separate and higher rate for large companies there. But for purposes now of the F6 exam, students will only need to use this rate irrespective of whether the chargeable accounting period spans an earlier or later financial year. So we only need to know the 20% rate of tax. But despite the introduction of this single universal rate of corporate tax, it will still be necessary to determine whether a company is a large company. Now, as I said a moment ago, back in the bad old days, we might consider it, large companies paid corporate tax at a higher rate than small companies. Now everybody's the same. They pay tax at this universal single rate of 20%. But if companies are large companies, then they may be required to actually pay that corporate tax in a different way. So it is important for us to be able to determine, if we're asked to state when a company and how a company will settle its corporate tax liability, when will the tax be payable, we need to know whether or not it is large, and that's what we need to look at now. Right, we've said here, still need to know whether the company is large, as large companies are required to make quarterly instalment payments to settle their corporation tax liability, as we'll discover shortly. If you're not a large company and you're not required to make these so-called quarterly instalment payments, then any and all other companies have a very simple system. They must pay over their corporation tax payable. They must settle their corporate tax liability by 9 months and 1 day after the end of the accounting period. So if a company therefore does indeed prepare its accounts to the 31st of December each year, 9 months and 1 day after, the following therefore 1st of October is the date by which it must have paid that corporation tax liability. It must have settled that liability 9 months and 1 day after the end of the period. But if we are a large company and the relevant other conditions apply, then we'll be made to pay our quarterly instalment payments, and that will mean that we're going to start to pay that corporate tax well before 9 months and 1 day after the end of the period. As we'll discover, we'll actually start to make those quarterly instalment payments part way through the accounting period to which the payments relate. So, who therefore has to make these quarterly instalment payments? Who will be classified as a large company? Right, a large company here, let's get the pen working, is a company whose profits, I put in inverted commas there, profits exceed 1.5 million. This profit limit of 1.5 million provided to you on your rates and allowances page there, along with your rate of tax 20%. Profits are defined as, now there's a term, a little acronym we'll come to know and love, TTP, the taxable total profit. Taxable total profit. So profits are defined as the taxable total profit, obviously by its name, the figure of profit that will be charged to corporate tax. But in determining whether the company is large and therefore may have a need to make quarterly instalment payments, we take that TTP and add on to it dividends received, excluding dividends from related 51% group companies. Now, that tells us another thing other than how you calculate profit. Taxable total profit plus dividend income there. Dividend income other than dividends received from related 51% group companies, and we'll define that in a moment. But that should tell you something else. TTP, taxable total profit. That therefore does not include dividend income. Important issue. Whereas you or I, as individuals, were chargeable on our dividend income based on the dividends received in the tax year, companies are not. Companies do not pay corporation tax on their dividend income. Dividends received are exempt from corporation tax. Now, not that you'll ever have to explain it, but there's a logical reason for that. The reason being, think from your financial accounting what a dividend is. A dividend is not an expense of the company to be deducted in deriving its taxable profit. Oh no. A dividend is a distribution made out of its already taxed profits. So we calculate the profits to be taxed, we tax those profits, and out of the tax profit we pay a dividend to the shareholders. Now, if one or more of those shareholders are corporate shareholders, UK resident companies, the dividend income received by that company is now exempt from corporation tax. If it were not, we would effectively be charging to tax the same original profit made by the original company. We'd be charging that profit again to tax for a second time in the hands of the company receiving the dividend. We don't do that. Now, what you've got to know is dividend income is exempt from corporation tax, but it is not to be ignored. It is not irrelevant in the context of our studies of corporate tax. The reason being, we add it to TTP to give you profit. If that profit then exceeds the relevant profit limit, there we're told about £1.5 million. If we exceed that profit limit, depending on what has gone before in the previous accounting period, we may or may not be required to make quarterly instalment payments in relation to this period. More of that in a moment's time. We mentioned there about excluding dividends from related 51% group companies. Now, we have a separate chapter indeed on groups of companies, and we'll remind you again at that point about what they are. But it's very simple. Companies are related 51% group companies either where one company controls another parent company, subsidiary company, or two or more companies are both 51% subsidiaries of another company there. So co-subsidiaries. So if you had a parent company with two wholly owned subsidiary companies, then there are three companies that are related 51% group companies. The dividend flowing from the two subsidiaries to the parent company, that is excluded from the dividend income to be taken account of in determining the profit to determine whether the company, the parent company there is large. But it's going to be relevant to know how many, in a group of companies, how many related 51% group companies there are. Now the reason why we need to know it, and I repeat again, parent company, two wholly owned subsidiaries, there are three related 51% group companies. And that is important to know because the profit limit I just referred to, the 1.5 million, that is referenced as regards determining is the company large, will it have to make quarterly instalment payments or not, that profit limit, so far as a group of companies is concerned, is divided out by the number of related 51% group companies. So in my little group there, parent company, two wholly owned subsidiaries, three related 51% group companies. In determining for each company, is it large? Will it be subject to paying tax under the quarterly instalment payment system? We will not use a profit limit for each of 1.5 million. We will instead use a profit limit of 1.5 million divided by the three related 51% group companies, i.e. for each one £500,000. So you see there how that profit limit of 1.5 million might be reduced. It can be reduced for another reason as well. We made reference a few minutes ago to the fact that a chargeable accounting period can never exceed 12 months, but it could be a short chargeable accounting period. If we have a short period of account, it would become a short chargeable accounting period. And if we have a chargeable accounting period of less than 12 months, then that self-same profit limit, the 1.5 million there, will be time apportioned. So if a company prepares its accounts for a 6-month period and has a corporate tax comp, a chargeable accounting period for that 6-month period, its profit limit would be just 6/12 of 1.5 million. Half of that, it would be 750,000. If it also had two other related 51% group companies, there were in this group three related 51% group companies, we would then go on to divide that profit limit, now 750,000 for this 6-month period, by the three related 51% group companies. So each company now within the group having such a 6-month period would have not a £500,000 profit limit, 1.5 million divided by 3, but would have a £250,000 profit limit, the 750,000 divided by 3. Now that is made reference to here. The limit of 1.5 million, that's for a single company with a 12-month chargeable accounting period. So as we said, it would be divided by the number of related 51% group companies. That number, by the way, in case the group structure is changing, is the number of such companies at the end of the immediately preceding accounting period. So if therefore we bought a new subsidiary or sold an old subsidiary during this particular period, it's not going to impact on the profit limit we use for the period. It's based on the number of related 51% group companies that existed at the end of the previous chargeable accounting period. And as we've just been talking about, if we're talking about a short chargeable accounting period, then we must time apportion those profit limits as well. Now again, just as an example there, one that I think you can indeed work through very quickly and easily for yourself, but we've got large limited, accounts at 31st of March, year ended March 17, TTP 600,000. Remember, taxable total profit 600,000. It also received dividends for a number of companies, including its two wholly owned subsidiaries. So in working out its profits, we would include the dividends from the non-related 51% group companies. Dividends coming in from its subsidiaries, ignored. Dividends coming in from other companies, they would be added to TTP to give you the profit figure for comparison with the relevant profit limit. Now then, we're also told this was its lowest profit recorded in several years. More about the significance of that later. Now we're told that it's got two wholly owned subsidiaries, but it is a corporate tax comp to be prepared for an accounting year. It's a normal 12-month period. So it's got two subsidiary companies. So as we spoke of a moment ago, even without reading it there, there's two related 51% group subsidiary companies. There's the parent company. So overall, there are in the group three related 51% group companies. So what do? We divide the 1.5 million by the number of such companies, 3, and that will revise down the profit limit for each of those companies. It's split equally between each of those companies to £500,000. Well, now we know that the profit limit is 500, and we already know that the TTP was 600,000. The extent of dividend income that would have had to have been added to TTP to give you the profit figure has become irrelevant, because at £600,000, let alone any higher figure that the profit might come to, we're already above the revised relevant profit limit of 500,000. The company, therefore, is a large company. So, as large as it has TTP of 600,000, even without including the dividend, profits exceed the relevant profit limit. It will therefore be required to make quarterly instalment payments to settle its CT liability for the accounting period. See Chapter 23 for details of the quarterly instalment payment system. Now, I said this was its lowest recorded profit in several years, as we will discover, depending on the level of profit made by the company in the previous period, and whether it was large or was not in the previous period, that will dictate whether in fact for this period, the period that we know is large, whether quarterly instalment payments are required. But the details of that, all the fun there, that awaits us in Chapter 23 when we deal with the self-assessment system and administration system for corporation tax. Little note there in relation to corporate tax and chargeable accounting periods. Again, we've seen questions over the years, and you may get an objective testing question, for example, in Section A that tests in its own way there this particular issue. Chargeable accounting periods. What do we know about them, and when will they exist? Chargeable accounting period will normally start immediately after the end of the preceding chargeable accounting period. It will also start when a company commences to trade, or when its profits otherwise become liable to corporation tax. Now, for us, that will simply be when it commences to trade. A chargeable accounting period would normally finish 12 months after the beginning of the period. Remember, we cannot have a chargeable accounting period of more than 12 months. Or at the end of the company's period of account. If you have a short period of account, then you prepare the accounts to that date. The chargeable accounting period will be for that short period. It'll be the same as the period of account. It will also finish when a company ceases to trade, or when its profits otherwise cease being liable to corporation tax. Again, for us, it's cessation of trading. So we now know, therefore, the three basic definitions and for what periods we must prepare the corporate tax computation. In the next chapter that we'll see, we deal with that specific problem of the long period of account and dividing it into two computations. But again, to begin with, we need to know how to prepare one computation and what it looks like. Now, here we have a pro forma computation here, a pro forma computation. Again, it will be headed up in the name of the company, A Limited, A PLC, whoever that may be, and we'll have the title here. What is it? It's a corporation tax computation. When is it being prepared for? It's being prepared for the year ended March 17. Now, at the bottom of this computation so far, we will compute taxable total profits. That's the first and major part of the computation then complete. After that, a bit like after taxable income on an income tax comp, we have to compute the corporation tax liability. But whereas that could be a very significant problem on income tax, it's ever so easy on corporate tax now because we've got this single universal rate of 20%. So that's not going to be a difficult exercise. We said we calculate TTP. Up here we've just stated company's corporate tax liability for the accounting period calculated by computing profits, income and gains from all sources. Taxable total profits there, we're going to include our worldwide income and gains from all sources. But we also get to deduct qualifying charitable donations. This figure is known as TTP, as charge of tax at the single corporate tax rate. We have a very simple system in terms of corporate gifting to charities. That will be a qualifying charitable donation. We don't operate the gift aid system here. It's just a qualifying charitable donation, and as we'll see, will be deducted in deriving TTP. Deducted from a figure known as total profits. Again, there's no personal allowance, of course, for a company there. Now, what will its total profits be? Where do we think most of the company's profits will derive from? Well, I think pretty obviously, most companies will derive most, if not all, of their profits there from its trading activities. So it's going to be its trading income. And this, therefore, brings back into play the areas that we looked at in Chapter 4 and Chapter 5. You may recall that at the time I referenced, have a little look at these before you study or go into corporate tax. We've probably forgotten. Again, there's been a lot of water under the bridge since then, as they say. But it would be a good idea before we go any further, once we've just discussed this format of the computation, for you to go back and have a little look at those basic rules of adjustment of profits and capital allowances. We'll then, in our next lecture together, talk through the differences between what was in Chapter 4 and 5 relevant to unincorporated trades and what we now have to do in terms of corporation tax. For trading income, we're going to have to establish our adjusted profit, deduct capital allowances to derive, as we would for an individual, a tax-adjusted trading profit, but it'll be for this chargeable accounting period, its normal accounting year end, as we know it tends to be. That, for many companies, will be it. It won't have any other income or gains. It won't be gifting to charity there. So that will be it. And that's where most of the work needs to be done. So those exercises on adjustment of profits, capital allowances, may be set in the context of either the unincorporated trader, an income tax problem, or an incorporated trader, a corporate tax problem. You need to be able to deal with them both. What else comes in? Remember, we're taxed on our worldwide income and gains. We've already stated that dividend income is not subject to corporate tax, but what will be interest income. And the basis of assessment here, we work on an accruals basis throughout in terms of our income. Interest receivable there, not received, interest receivable. therefore in line with the way in which the statement of profit or loss would have been prepared, again on an accruals base. So interest receivable. Our property income, again on an accruals basis. Rental income accrued, less allowable expenses incurred. Something there that you were familiar with in income tax, indeed, where the same system applied, only there for the tax year. Here, it's for the chargeable accounting period. We will also need to record, if there's been more than one disposal, the net chargeable gains of the accounting period. So looking at the date of disposal of assets during the accounting period, we would establish any chargeable gains, any allowable losses, and the net chargeable gains would be included here on our computation. And if we add up, therefore, our worldwide income and gains, we get total profits. That term there, total profits. But if, and only if, it doesn't happen all the time, the company made qualifying charitable donations, i.e. a donation to a qualifying charity there, then those are deducted not on an accruals basis, because there isn't any such thing as payable. Nobody makes you make a donation to a charity there, but those will be deductible as and when they're paid. They'll be deducted on a paid basis. And that then will bring you down to your taxable total profit, your taxable total profit. Now, as we said just in these notes, dividends received from other companies, whether it's UK and overseas, for us it's only UK, are not taxable. Dividends paid are not deductible. You don't get an expense item there for a dividend. Remember, they're distributions out of what you go on to compute as the tax profit. Companies pay corporation tax, we said, not CGT, in relation to their gains. And we've got a series of chapters that then will deal with chargeable gains for companies. Okay, I'd like you to familiarise yourself with that pro forma computation and also have a little read through the following information there in relation to the other issues that pertain to the preparation of this corporate tax computation. I'll run you through that very briefly next time, but also in between times, revise your adjustment of profits and revise your capital allowance rules. And on that basis, we'll then look forward again to seeing you in the next, what will be the final presentation here in terms of this particular chapter on our introduction to corporation tax.